Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, we've got a non-farms payroll today. And, I don't really know what it's going to be here in January. I find that the first non-farms of the year can often be a little bit like, I have never had a huge win on it or anything. Next month, when they do the yearly adjustments and everything, that will be very interesting. But for today's number, I don't really have any expectations. But let's come over to the charts, see what we've got for us. I wouldn't expect too much of a big change from yesterday because we were closed due to the day of mourning. Funeral for Jimmy Carter. Here you can see the treasuries a little bit on the hawkish side here today. Again, trading near the lows. Well, not the lows of the range, but the lower than yesterday. S&P 500 just kind of trudging along. There was a little bit of a decline here that they retraced. Oil is taking another big jump and just careening. So when it was starting to do all this, I was like, okay, maybe it's going to moderate here. Looks like that was dead wrong because it is blowing through here in oil, and I'm honestly not entirely sure what is driving that action. But oil has been, if you look at a larger chart, we have been relatively low in oil. So okay, so gold and silver are, well, okay, silver not as much, but gold is definitely looking pretty good trend here the past few days. And then we got copper. Copper continues to look good. So I do like this theory that copper may be increasing because of how much rebuilding they're going to have to do in LA. I don't know if that's really actually enough to like really make a measurable difference. Well, you can have these things where like even a small difference can have a big impact on things, right? So I have to continue watching that. Japanese yen still just kind of going sideways here, and the dollar at just below 109. And then Bitcoin. Okay, well, Bitcoin is trying to get something started here, a little bit of a bounce, but it's still looking pretty ugly. But you know what? They survived that swing at like 92,000, so that's good for them, I think. On the larger chart, Ray SS, good morning. All right. Let me come over here and see if I got any more information on the payrolls. Well, what I'm reading here on Zero Hedge is kind of just what I was saying, that like the bonds reaction to the first payrolls is not usually very big. Okay, well, what are the estimates we got? We got about a minute and a half. U.S. non-farms payrolls are looking for a reading of 165K. That'd be pretty standard. I wouldn't expect there to have been anything too crazy happening over the month of December, so And they have unemployment rate unchanged at 4.2%. So I guess we'll see how it goes. Good morning, Octavius. Yeah, anyway, you know, if nothing interesting happens, we have that that setup to test from yesterday, right? Tried to cool the room down today. It's better. It does feel better. Okay, so we are going to the downside here. Oh, pretty big win. Whoa, hold on. So we're getting 265 versus 165, so almost 100,000 more than expected, and the unemployment rate ticked down 4.1% versus the expected 4.2%. Let's see here. And it was coming from private payrolls this time as well, higher than expected, 223 versus 140. Want to see average hourly earnings? Okay, that's in line at spot 3%. Okay. So we kind of have an issue here where I feel that the bond market is oversold, but that data is a reason to sell treasuries. It is. Now, it's really hurting the stock market as well, so I guess that's all in line. This whole thing where the treasuries have been selling off like hardcore and equities haven't really been affected by it is also really just too much of a disjoint for me, and I feel like that something's got to give. So probably the easiest way for that to kind of resolve itself is for the S&P 500 to fall by quite a bit, and it is an oof. It is an oof. Uzi saying oof there. It is. I mean, how much have we fallen here? Almost 50 points essentially. That's pretty big. Now, trading the aftermath of this one, this tend to be a little tricky, right? So it may just stay down here and grind. That can be frustrating. But you can also have retracements that are much larger than anticipated. That, I think, is probably what's going to matter there is what the dollar does. Right, so let's zoom that in a little bit. Let's keep a close eye on the dollar there. I do kind of think I could pull ticks out here. So I'm hearing on the news squawk that the markets are still pricing that there's one rate cut this year, but in June. Which I find kind of curious, like that with as high as the rates have gotten, that's still pricing in a cut this year. Okay, that wasn't too bad. I kind of feel like I should be going for more than that, but like that's what I saw. More than that would be like let's really hold this and let it extend, right? But I'm happy with that one because where is the position? Okay, two adverse ticks. It's not terrible. Yeah. So it's kind of funny. The thing I was saying is that the January report is usually not that interesting. That's definitely not the case this time. We got another huge print. What a big iceberg there. It's 15 that they blew through too, by the way. It's kind of funny. This is kind of the situation that we were talking about yesterday. That you know, they were saying reverses, but I don't think I'd be going for a reversal on this. Odds of a revision downward, who knows? I mean, the revision craziness did kind of chill out the last like 2 or 3 reports. But you know, this just comes back to this whole debate about like, okay, there's something really off with these numbers, and people claiming that it must be the Biden administration cooking the numbers. Well, I really don't think that the Biden administration or the Bureau of Labor Statistics goes through on each individual report and says, okay, what do we need it to look like for optimal politics for us, and we'll kind of adjust the numbers based off of that. No, I don't think that's what they did. I think that what they did was that they made an adjustment at the beginning of Biden's term related to how they do adjustments and so forth that kind of increases the difference between the initial report and the first revision. So with that in mind, you know, I think that there will be probably relatively major revisions, but I don't know if it's going to change, you know, like for interest rates. I don't know that after the revisions that treasuries will think any different of it, you know? And the reason for that is that, well, I think there's 2 things that I think are relevant here. One is that there is some hidden weakness in the economy. We are essentially going through a white-collar recession, and people that are looking for jobs right now are having a very, very difficult time. Partly because just, you know, there was a lot of layoffs last year, so there are a decent amount of people that have been displaced. They're finding jobs, but they've been displaced, so there's competition. And then companies have increased what you have to go through to get hired. So that has kind of resulted in a tight market that I really don't think that you can let interest rates get too high before things start breaking again, right? Like banks are go under because they can't handle the unrealized losses and things like that, and you're already kind of got a situation that could roll over into like a real recession very quickly. So you've got all of those things going on, right? And then the competing force, if you could say, to that is Donald Trump, because the political establishment believes essentially that Donald Trump will cause inflation, that his policies are likely to be inflationary. And the members of the Federal Reserve are quite concerned that his policies could be inflationary, right? So those 2 things are probably the biggest factors behind what interest rates are going to do over the next year. Ergo, you know, what happens with non-farms might not necessarily be the turning point on it, right? So the first week of so we get one more week, and then after that first week of Donald Trump's presidency, is where we will see what he actually does with executive orders. And, you know, then the market will kind of adjust. Then we'll probably get a clearer picture. Tilt saying not necessarily. Well, so it kind of depends on the time frame that you're looking at, but this is a situation where you had a big down bar, and then the next bars after that are much smaller, but higher volume in some cases. So you're saying that you missed the details, but whatever those details are, like, we can program those details in. But this is where I'm saying again, like, confirmation bias, right? You'll sit down and you'll say, okay, here's a setup. I believe in this setup. I see it here. It works. That, you know, that's you know, that one counts. And then you'll get another situation and it meets the same characteristics, but it doesn't work that time. And you say, no, that one doesn't count. And so now, because of confirmation bias, you're going to look for all of the reasons in your head that it's wrong in that instance, that it shouldn't count in that instance, right? Okay. Well, if we say that it shouldn't count in that instance, then we program it up and we see the results of it, right? What would be the details in here that would change it? Well, I think one of the key things that you're going to have to worry about here when we start going through this is that this is going to like to trade after big releases. The situation where you get a relatively large bar, you know, followed by a tight bar with lots of volume, those are going to happen a lot after reports. In fact, depending on what kind of settings you set, it might only pick up reports, you know? The volume on the narrow squat bar needs to be much higher than on the big bear candle. Oh, I think that is the case on this one, though. Let's see. Probably it might be close. Let's see. So I think the first thing is this does not sound to me like something that I can do with a 1 minute chart. You know, I think that this would make more sense on a 5 minute chart. Okay, so we have enough on here on a 5 minute chart. Now we're not doing order flow. We're not doing like change in cumulative delta or anything like that. We're just doing volume. So volume. Okay, so it is not as high as the first bar. So if that's the qualification, you say much higher, but like that's where you're saying like those are details that you have to specify. So let's try. Oops, that's not what I wanted. I wanted a new Ninja script editor. What I'm seeing though is that the delta, that they continue to sell through that. So I wouldn't necessarily read that as a like, oh, this is going to extend further. I want to go short sort of a situation. But I'm not going to be very interested in the reversal. I'll tell you that much, right? Okay, let's just minimize this little one right here. New strategy. Tilt. We'll call it tilt for now. I don't know if you have a better name for it that's more descriptive of what it actually does. Okay, so we need to find range equals so the other thing is you don't want to count like what would we call these? You know, you get these bars where like the range of the bar is really, really big, but it's like a cross. You know, like the open and the close are similar. So I don't think that we want to pick those ones. So I think that we need to say the open of 0 minus the close of 0. Right. Actually, let's do it the other way. Close, because that will give us signs the correct way. Okay, so with the net change of the bar, if, or let's just call it double change. If change is greater than, and what can I call it? What do we call these bars? Let's just call it threshold for now. Now, do I want to do it like, you know, well, yeah, I think I do. So one of the things that I'm thinking about here is how can I make my calculations and everything as efficient as possible? So we're talking about something where I'm looking for a condition where there's this bar and the bar before it meet certain qualifications, right? So what I can do is I can say, okay, first look at the current bar. Is it relatively narrow bar, right? And then I can say, if it is, look at the previous bar. Is it a really big bar, right? Well, the thing is that the previous bar being a really big bar is not going to be very common. So if I instead go in and say, okay, when you detect a big bar, like set a flag so that the next time around I go and I do this check, then that will be less checks overall. So I don't know if it really makes a huge difference, but like when you're back testing, it's like just teeny tiny little things like that can make a difference, right? So what I'm gonna do is I'm gonna come up here and I'm gonna make a boolean. I'm gonna say bool underscore trigger equals 0 for false. Okay, and then if the change is greater than the threshold, actually we'll do it both of those here, or the change is less than the negative threshold, so triggering it long or short, right? And I'm gonna say underscore trigger equals true. Okay. Then before this, if underscore trigger. Okay, so if we have been triggered, then we have to say, now the question would be here, you're unintentionally hitting, actually, I think that you're unintentionally hitting on why, so here's the thing. You're making a claim about something, and then you're saying, my claim can't be proven because it's too fuzzy. If that's the case, then why do you believe in it? You're saying that there is some sort of inherent behavior that the market does here that you can't prove empirically. That's nonsense. There might be a lot of little factors involved, but this is exactly why you should be backtesting things. All of these little details matter. Okay, so if we're saying, okay, at what point do you say that a candle is a big candle? That matters. How small does the candle after that have to be relative to the first candle to count? That matters. How much more volume needs to be in the second candle compared to the first candle? That matters. These are all tiny little things here, right? I think what you're going to find when you go and you do this is that you're going to put so many qualifications on it that you don't get a lot of trades. You're going to find that you really don't have enough data to believe what you believe. I mean, yeah, because the way that this works, okay. So if I have a bar, it's a really big bar, and then I have another bar that's kind of a small bar. And the volume on that is, here's the volume on this one, and here's the volume on this one. So a lot more volume transacted on this one in this short thing. And you're saying, oh, well, that's an order flow signal. Yeah. And what I was saying, and the reason that this came up, is that there is so much data inside of this bar that you are not seeing with the net volume. What was the net cumulative delta? Because I tell you what, if the net cumulative delta was big time long on this bar, I think I want to hit into that. That is probably like somebody has a hedge there that they have to get filled, and there was an iceberg, and now that that iceberg is filled, they're just gonna bust through. Versus if there was the net cumulative delta, or the net delta, let's say, it's not cumulative because it's just one bar, okay? If the net delta is short, then that could be signs of another meta order coming in to meet it. So if there was a big buy, there's a big sell, I would, be looking for this. I would be looking for the next bar, if that selling continues, of course, to be larger than this first push up, right? Like there's data in there. Now, of course, those are just some kind of ideas that based on like would the impacts that we know orders have, and
block sell,
all of that stuff. That's like a theory. If we collect the data for long enough, we could test to see if those things are actually true. Okay, but I think that you're going to find that this setup right here is not really very predictive at all. And sure, you're going to say, well, because it doesn't, the qualifications aren't exactly perfect. But you have to have a strategy, right? Like there has to be rules to what you're doing. And any of those rules can be programmed. And I have the talent to do it. Whatever it is that you think matters about, how do I decide how big this candle should be? How do I decide, right? But we can come to those problems when we encounter them, right? Let's do the simplest application of it first. Okay, what makes you think that applying? So we are not going to have a stop loss and take profit. We are going to use a time-based exit. That will give us a range of values that tells us essentially, it gives us a better view that we can look at statistically of after this event, what happens. Right? Because if we stay in it for a certain amount of time, then we can say, okay, right? So we're going to look at the net change after 5 minutes, or after 5 bars, let's say, after 5 bars, after taking the entry, right? And then what is that net change? And you're going to get a distribution like this probably, right? And if there really is a propensity for it to reverse, then there should be a skew to it. There should be, here's 0, and maybe it goes like this, where this side is kind of has a longer tail, right? So that's how we're going to deal with that issue. There's Octavius taking that hero he's talking about. Well, there was a really big buy there, so I see why he's taking that. Yeah, you can base it on time. Like the thing is okay, so you're gonna have a stop and a loss targets and stuff like that, right? Okay, so if I take an entry and I'm looking for 10 points on the S&P 500, and then the next bar I get filled. Okay, cool. And then the next time that I do that trade, I don't get filled for 3 days. It's kind of like, was me getting filled 3 days later have anything to do with the signal that I actually got? Like, no, of course not, right? So when you're doing a scientific study of the market, using set stops and targets in and of itself is kind of like a flawed way of analyzing it. You can go back and you know, run all your optimizations and all of these sorts of things to figure out like what is the best exit strategy for it, right? Because there's countless ways that you can do the exit, right? But if we do it on a time-based exit, that will give us the data that we need to understand the market and do the analysis, right? So yes, we want to use a time-based exit because that will make sure that our results are primarily a factor of the entry signal. See? Basically, time-based exit is kind of like a way of saying, like, randomize this part, right? If I just want to say, like, what is a random strategy? Then I say, take a random trade at a random time. Right? And that's a way of randomizing it. Because the issue is you have to have something that is what we call IID, which is to say it's independent and identically distributed. Okay, so when you set a stop and a target, that is not IID. That is related to the volatility of the market, right? But time, I mean, there are flaws with time, but time is probably the most IID thing in markets that you can look at. Okay. Wrong. The biggest advantage a manual trader has over a bot is his discretion. You can't code that. Yes, you can, because we have LLMs now that code human intuition. So we can code that. But that's very advanced. I don't think we're going to get to that today. Like, the thing that I think is weird here is that the argument that you are making does not help your larger argument. Because what you're saying is, I don't think that you can systematize this. I don't think that you can systematize this. But if you can't systematize it, how do you know that the signal is even a thing? There goes that mean reversion. I tell you what, that was crazy. But I can see why it worked, right? So it was that thing that we're talking about. Like, if you have a big move down, and then you have something of equal or greater, a meta order of equal or greater size, you're gonna get something like this. Those buys down there have a larger impact because of the liquidity hole behind it, essentially. So that's a trade that I personally wouldn't take, not because I don't think that it's a good signal, but because it's a really risky play during a pretty volatile market, right? So that's kind of like more risk than even in my sim that I'm willing to take on. But I could see that when it happened, I was like, okay, well, is that just the hero trade? But then I said, no, there was like a huge buy-in pulse in there. and it turned out. So that was a very, very interesting thing that happened. I'm wondering now, just for kicks and giggles, we have 23 right there is our line on cost basis short. So we'll see if they can get it all the way back to there. Like here's the thing that I think is always so weird is if I come in and I say the market exhibits some behavior, but then I say you can't just program for this thing because you can't deal with the human intuition side of it. Okay. Well, so you're saying that A does not equal profit, but A plus B does equal profit. And I'm saying, how do you know that it's just that B equals profit and that A has nothing to do with it? And you can just discard A completely. Well, the B is the human intuition part. Is it maybe all of the little things that you're not realizing about why you take this signal and you don't take this signal? And that's actually the edge. And this entry signal thing that you're telling other people about is some sort of inherent market behavior is actually nonsense. Right? Well, how would you test that? Well, you would have to test A. Well, how does A itself perform on its own? How does B on its own perform? And I would say that if, you know, this situation where A equals a profit and B, or sorry, A does not equal a profit and B does not equal a profit, but A plus B equals a profit, if you could prove that, that would be very interesting. Because that's like purely theoretical. This sort of a thing where it's like there's an edge, but you have to combine this and this together for it to work. Can you prove a situation like that? If you could prove a situation like that, that would be a pretty significant discovery. Right? Otherwise, I think that the null hypothesis in there is that if something doesn't have edge on its own, that it probably isn't going to have edge even when you combine it with other things. Okay. So if the trigger is there, so now we're going to say, we need another variable here. Public int threshold. Oh, this right here, by the way, should be in ticks. We should do it in ticks. You got +5. That's really good job, Octavius. That's a good catch. What were we calling it here? Doji. Let's call it Doji. Okay. So then we say, if we get triggered, then if... Oh, I guess we still need the range. If trigger... we should do it like change is greater than 0 and change is less than the doji threshold. And vol of 0 is greater than vol of 1. Let's just say to count in the greatest number of things, that is just, it just has to be higher volume. Oh, actually, it's vol. I'm going to change this trigger to be like an integer. Int trigger equals 0. Change is greater than the threshold, then trigger equals -1 because we're going to go short, right? Oh, I have these backwards, right? This one is when it was a big up move, right? This one is when it was a big down move, right? There you go. And we need one last thing. We need int bar entry. Bars exit. Call that bars exit equals 5. Bar entry equals current bar. If position dot market position does not equal market position dot flat, and so we are in a position, and current, or actually it would be yeah, the current bar minus bar entry is greater than bars exits. Hope that compiles. With oil and not natural gas. Oil is up big today, for sure. I'm really not entirely sure why oil is going up, but I don't know. Listen, all of the moves that we're seeing right now in January, like, watch it, pay attention. Don't make the mistake of thinking that this is the final conclusion on what's going to happen for the next 4 years, right? The markets are likely to do some irrational things here before we really figure out what the real truth is. Okay? Okay, now on this, going back to this thing right here, I want to come in and change something, and I want to look at the last year's worth of 5-minute data. And I want to add my range histogram. Use area. So a big bar is definitely more than 85 ticks. And 20 ticks. Well, let's just do it like this. Thresholds equals 20. And doji thresholds equals half that. Let's just say this example. Okay. My first goal here is to just get something that like actually makes trades. Yes. 5-minute bars. Past year. No commissions or slippage or any of that. Oh, it does take trades. Oh, very interesting. I thought I was going to come in here and just see that it was a consistent loser, but it was not. It was mostly back and forth, actually. What did I want to see? Okay, sure. Pretty standard stuff. Okay. So on my exit efficiency, I should see it as relatively random. It's not as random as I would like. Okay, so it does work. Let's see. Can we see one though? No, that can't be right. Can't see that number. Where did it get in that? 5952. 5948. Oh, I know what's happening. Okay. This bar triggered it. And then it waited for the next bar after that had a doji, instead of them being right next to each other. Oh, well, that's very interesting that I made that mistake, because basically that means it will take more trades. In a year, it took 1,000 trades. How many trades a day a year is that? Come on, I know it's in here somewhere. Trades per day, 4. Interesting. But maybe that's trading more than we want it to, right? Oh, actually, we should do it like this. So on the second bar, if it doesn't get an entry signal, then it sets the trigger back to the default. did not change anything. Maybe if I do this. Better. Okay. Still pretty random. There you go. Oh, that one's perfect. Okay, wait. We need to add chart indicator vol. DS says shorter time frame. I kind of think that it wouldn't trigger very often if the time frame was too short, but that's it right there. You got a relatively large down candle. Then the next candle after that is kind of like a doji, but it is still going in that direction. And then the volume is higher. In this instance, it exited on the session close. This is kind of a weird one. But, wait, is that today? Whatever. It is today. Okay, here's one. Here's one very clearly. Big up candle. Change on the next candle's not too much. I guess it ends up being a doji, but it is still going higher. And more importantly, the volume is significantly higher than on the next bar. And so we take a short. Oh, actually, it's this candle triggered it, and then this one did it. So we go short. Oh, that's funny. It looks like news. Well, look, it's happening at 1400, so that's the close. That's around the close of the day. Here's another one. So this is interesting to me. Is it's actually, we're actually showing a little bit of hindsight bias. That there was a bit of hindsight bias in the original setup, because when we were talking about it, it was like, okay, it does this, and then it does this, and then it's gonna like maybe do this, right? But what we're finding, and perhaps this changes as we change the threshold, but what we're finding is that you'll get this. It'll do this, and it'll do this, and then it'll do this, and do this. And it'll kind of come up all over the place. Cost basis is at 23. Right? You're thinking of on a chart where like the only the candle that you can see on that chart is that one, so it stands out really obviously, right? But we're finding, at least with the threshold that we set, that you'll get bars that kind of seem like they are of equal size all over the place next to it. Now that's going to be less true as you increase the threshold. But you are already only getting 160 trades a whole in the year. Half of a trade a day. So do you really want to filter even more out? Then even if we got 5-10 years of data, we wouldn't have enough data. But It kind of seems to me this might be close. Just because it didn't work one way doesn't mean that taking the opposite of it will be profitable. But there's enough of a margin there that it just might be close. Yep. So our basic first pass on it says that it's not a reversal signal at all. Actually, the first pass on it is not too bad here. Hold on. Interestingly enough, it works way better on short trades too. Well, that's interesting. Okay, but 5 years now. Okay. So it worked really terribly, or it's not worked really terribly. Trading against tilt worked really terribly during COVID. But then since about 2021, trading against tilt was profitable. I'm a little disappointed though, because I wanted to, go a little bit further, because he was saying, oh, like all of these little tiny nuances matter. And the issue now that you're going to get is any kind of nuances that we add on it is just going to reduce the total number of trades taken. And it's already at a point where I don't know if you can really make a whole lot from these results. Like I'm really 400, let's say 500 trades. You're not really getting a lot on that. Like, it's just not. Also, it works for long trades and not short trades, which kind of says that, man, he says that it's missing so many details of the methodology, it's laughable. Okay, but did you hear what I had just said? Or maybe you typed that before I said that. The details that you're going to add are going to reduce the number of trades that it takes. Like, I'm giving you something that's pretty broad. Like, it's just meeting the minimum requirements of what you're saying. And I'm using thresholds that are really generous too. It happen like relatively frequently. So if any little rule that you add is just going to filter, you have this universe of trades here, right? And any filter that you do is just slicing that smaller. Now, if there's a detail that expands that, then that would be a different thing. But what was I going to say? It works well on long trades and not short trades, which basically just means that this is probably taking advantage of the propensity for the market to move up, right? So what we can do here, though, if we really want to go, get crazy with it, is we can, here are all of the trades. Export. Tilt. Do you actively use square root calculations to trade? No. So for what we're doing, being that precise is not necessary. But understanding the square root law and the consequences of it is really important. Hmm. Will that work? I can't remember if you can just have it, instead of it actually being comma separated, that each value is just on a new line, if that actually, it will read that correct. Okay, it does read that. Cool. Nope, that's not what I want. Hold on a second. Let's see here. You can't shoehorn a preset rule based on a bot to a market that never has the same candle volume structure to think that you may be... Well, okay. How do you want to change it, though? I think that there's this fundamental... You're saying like something more fundamental here that is wrong, which is that it can't be programmed. If you can do it, it can be programmed. What are you doing but looking at a bunch of different things and comparing data and making comparisons on these data and using that to make decisions? Unless there's some sort of mystical magical force that you're also pulling in on that makes the trade work. Or, you know, it's sort of your process is actually random, right? If there's an actual... So again, we're saying there is an inefficiency in the market, or there is a tendency in the market. If there is a tendency in the market, we should be able to prove it with data. You might need to have really complicated logic, okay? But then here is where we say, okay, this logic is not complicated enough to capture that tendency. Then where do you want to change it? And the big thing that I would say is that it already doesn't take very many trades. So however you would want to change it, probably better make it take more trades. So for instance, right now I'm using a set threshold for what is a big bar. You might want to change it to say, I need a bar that is larger than the standard deviation of the current range of bars, right? It's going to result in less trades, though. How do you program different entries and different exits that have different... Well, because we could go in and we could say add or set stop loss and set profit target and set them to specific numbers, and then go and do an optimization run and have it try every possible different combination of those to see if there's one set that work and don't work. I mean, there's certainly this thing is like you get in an entry and then it goes up and it goes back down, and then we get out after 5 minutes, and so it shows it as a loss, right? But that information is still captured in what we've got here, because we also have MFE and MAE. Right? I think you should try to make the code as winning as possible, and then try to find... I don't know if that's... I don't know if that makes more sense, actually, to be honest with you. Because you have a thing and then you change it to add more trades to it, why, especially if the number of trades that you add is like several times more, which is what we need in this case, than what the original thing is, then it's pretty unlikely that this broader set of trades are going to have the same statistical characteristics as this original set, right? So that's why I think it's actually better to go the other way. Say, okay, here's this big, huge field, and this big, huge field has properties that we like. Now, can we find ways to filter this out and take some bad ones out without it taking the good ones too? And, you know, kind of slicing it in, I think makes a lot more sense, actually. I'm not sure why you would say, let's make it work first and then increase the number of trades. The stop loss is set at structural points in the market, and I don't use take profits to control the stop based on the structure. Yes, you can. I think that you don't know how to program, and you don't realize what's possible. But I'm straight up telling you that there is not a thing that you can do as a human that I can't program. It's just a question of how much effort I want to go through to program it. And that includes adding all of these things to say, here are specific points that I think it's going to go to. But I can just kind of tell you right now that that's nonsense. Like, that your take profits and take losses are going to basically just follow volatility. And I've tested this many times. And this whole idea that, like, you know, setting your stops and targets based on certain key levels that existed at the time of the trade doesn't work. That the volatility is what comes. Now, we just won't come to, no. You're just wrong, Tilt. I'm sorry. But this is not a matter of opinion. We're talking about a question of empirical fact. We're talking about a question of empirical fact. And you made an assertion. You made an assertion about the reality of the market. And I said, that's very interesting, but can you prove that? And the answer is, no, you cannot. And then I said, well, that's something that we should be able to collect empirical evidence on it. So we took a shot at it. And the empirical evidence that we collected with the model that we collected says that that model doesn't work. So you don't like the model, okay, you can make a better model. But until you can make a better model, you do not have any evidence that the characteristic of the markets that you claimed exists. You don't. At this point, the trade that you have proposed it's like fairy tale shit at this point, right? Like, you're believing it because you just believe in it. Because we have zero empirical evidence to back it up. See, you're okay, you're bringing up volatility and candle. So here's a lot of other things that are like, those are great theories, but can you prove it? So we had one theory and we couldn't prove it. So now you're saying if I add 20 other unproven theories onto it, then it will all work when you put it all together? I mean, come on, man. But the reality here is that you are trading on something that you have absolutely zero evidence works. You have been fooled by randomness. You traded it yourself. You think that you made money with it, or it seemed like it made money or something, but you don't have enough data to. And when we go and we take an empirical snap at it, It doesn't give you the results that you like. Here's the thing: if we traded this up, and it came out that like it won 80% of the time, and you know the winners were really good and all, then we would be like, whoa, what the hell, right? Okay, yeah, maybe our model isn't perfect or anything, but there's certainly something at work here, right? It didn't work like that. Okay, let's see what's up. I mean by that is, let's say the win rate is 80% with 300 trades. We can alter the code in a way which lowers the win rate to 60%, but the number of trades increases to 600. Sure. Okay, so let me back up here, right? Here's the problem with that. I'm trying to think of, can I draw something here to describe this? I don't think so. So like if I have a model, right? And I have a bunch of different parameters on the model, and then I go and I, you know, change the parameters until I get really favorable results with it, right? Okay. We call this overfitting, right? You've changed the parameters to match the past market, and they don't end up matching the future market at all, right? So the issue when you get down to with that is, like, if you were to do something to, like, you filtered it down to 300 trades, right? At that point, you've almost certainly overfit it, right? So the approach that I'm always going to take is, like, what is the key theory that I have with the market, right? Okay, program that up, see what the results of that are. If I get some sort of a statistical curiosity in there, like maybe my MFE is substantially larger than my MAE, for instance, right? Then I'm going to start going in and saying, okay, like, is there things about when it fails, like, that I can explain why it fails? If so, maybe I can make a filter that really improves the performance of the strategy, right? Like, one of the things that I'll do a lot is, like, okay, was the market trending or not trending at the time? Because the market trending or not trending, that might have a substantial impact on the effectiveness of the signal, right? So here's what I'm seeing here, Tilt. The other thing that I'm seeing is that I'm telling you things, and your comments that come back do not address any of the problems that I've explained to you here. So, like, you've learned nothing. The things that you believed at the beginning of this that are demonstrably wrong, you still believe. Like that adding these discretionary details in there, is that going to increase or decrease the number of trades that it's going to make? And if that decreases the number of trades, then that doesn't really help you. Because now you have so few trades that you can't actually get real data out of it. Okay, so I wanted to change this really quickly. It's gonna take like 500 something such trades, right? I was a little bit wrong. Oh, that's not right. So according to your claims, no one makes money trading ever. No, there are people that make money trading, and you know how they did it is they collected a ton of data and they did exactly the kind of analysis that I'm showing you here. And if you have a large enough amount of data, you are able to find inefficiencies. It's hard because those inefficiencies are smaller than the noise, but there are inefficiencies that are in there. And then, using all of their data science and everything, they were able to find profitable trades in them, and they make money. Now, a lot of retail traders, by and large, pretty much all retail traders fail. And most of the strategies that retail traders are going to tell me don't work. And why is that? Well, I've told you here. Because you're all trying to look at a 1 or a 5 minute chart and make decisions based on the past price movement of that 1 or 5 minute chart. And that's a great, I can see why that would be the first way that you would try and analyze the market. That's the way that a human mind likes to analyze things. But all of the profitable strategies that we know of that are proven always involve bringing some other piece of data in. Oh, I've never seen one. One is statistical arbitrage. That's 2 data series, not one, right? Momentum, that's a whole portfolio. That's hundreds of data series doing that, right? High frequency trading, that's where you start incorporating order flow stuff. Okay, so pretty much anytime that a retail trader comes and gives me some sort of a technical analysis thing, right, I can be pretty confident in adopting the null hypothesis. The null hypothesis being that the market is just random and that the strategy they're talking about does not actually result in a profit. Okay, well, but then the question would be, why do people think that it works? And that's where they don't have enough data to see it, right? And there's this other issue of it that, again, somebody having made money from trading does not prove that a certain market behavior or tendency is actually a thing. Because they might have just gotten lucky. Yes. See tilts. Because the only way that you can prove this thing is with what? Empirical evidence. Listen, this is what you're saying to me. This is what you're saying to me. I think that that flies spontaneously materialize out of thin air. That's my theory. And I'm like, well, why do you think that? Well, because they just show up. And I'm like, okay, but I think that they lay eggs and that, because I live in 2024. I know that they lay eggs in dead material and those eggs are just so small that you can't see them. And then the flies grow. And how do I know that? Well, because you can look at them in microscopes and all, right? And I can prove that to you by giving you a piece of rotting flesh and you looking at it under a microscope and seeing the eggs and watching the flies hatch, right? You can look at that and you can prove it. And then we're gonna say like they spontaneously materialize. Like how do you observe that? And you want me to believe that if I can't prove it? It's like, this was the way that society worked for hundreds of years, right? Was people would say these things. They'd be like, if I throw these chicken bones on the ground, those chicken bones are able to predict the future. And people would be like, okay, sure. And if, the person had enough authority, or, they respected that person or whatever, then maybe they would believe them, and they would think that throwing chicken bones on the ground is able to predict the future, right? But then what would happen is people would make decisions on these things, and like maybe it didn't work out all the time, right? They say, well, chicken bones, they predict the future, but like they're not perfect. Okay. So how do I know if chicken bones can actually predict the future? And we struggled with this issue. We struggled with this issue for hundreds of years until the Enlightenment. And then what happened in the Enlightenment is these guys, they came up and they said, well, if I can create a model of the way that the world works, and then I'm able to show that the actual results of the world statistically match the statistical results that I get out of the model, then that shows that model is effective at showing that particular behavior or property about reality. And because you can collect this data, anybody can go and duplicate it, right? And this is called empiricism. Empiricism. And empiricism was the thing that got us out of living in shit in the streets to the society that we live in today. And it frankly, it just astounds me the number of people that live today still that don't seem to understand what empiricism is or the importance of it, and that they want to go back to the Middle Ages and just kind of trust some guy that they read on the internet or something because that guy says that they made money, right? If you want to prove something, you should be able to prove it empirically. Because if you go and you say, here's this particular setup, and here's all of the discretionary things that I look about in the setup, and I made money with it over a 6-month period, therefore, this is a property of markets, and you go and you submit that to a financial journal, they're going to laugh at you. Why? Because what they work in is empiricism. The people that were at the prediction company, first people that started making money, like a company making money quantitatively off of markets, they used empiricism. When I worked at Goldman Sachs and I spoke to the traders there, they used empiricism. They read studies. They said, if you wanted to propose something, a strategy or something like that, you had to be able to provide evidence for it, that they could like look at and verify that the market actually behaved the way that they said. Okay, and then I come into the retail trader world and everything is, this works, trust me, I made money from it. And then you wonder why 95% of retail traders lose money. What does the center of the earth consist of? Well, we have some models that suggest that it is a very, very dense material, probably iron. But we've never been able to dig down to the center of the earth to really collect hard empirical evidence about what's down there. So I would only say that we have some pretty good theories about what's down there, right? You see, now what you're doing is you're scarecrowing. I never met an NBA player, so there must not be an NBA. What I watch on TV is a simulation and not real. You're constructing some argument that I never made. The argument that I made was you're claiming a tendency about the market, and I'm saying you can't back that up with empirical data. That's the argument that I made. Actually, like, talk about the actual argument here. With overfitting in a certain way and creating different sets of codes with it, and then trying to test these in a sim account, be a time if I don't think so. I think that when you overfit a model, basically you're just still in the random world, right? Yeah, I think that overfitting is necessarily bad. I mean, like more broadly, the number of variables that you have in your model, the more variables that you have, the less likely you are to actually find an actual inefficiency in the market. Okay. I haven't seen you in a while, Kevin. How are you doing? UB, pretty decent reversal. Dow new yearly lows. NQ pretty close to yearly lows. So the I think that I'm kind of like at a wait and see point here in the markets, because you kind of got two things. One is that there are some weaknesses in the market, and it remains unseen whether those weaknesses are really truly indicative of something larger going on here that's problematic, right? And then there's the other side of it, which is Donald Trump's administration is going to come in, and some people believe that his policies are going to be inflationary. The issue with that is that we don't really understand what all of his policies actually will be. So we have another week, and then Donald Trump will be president, and the first week of him being president, you're probably going to see like a PR push with a bunch of, policies being released. I'm bet you that at some point there will probably, so that in itself is possibly a trade, right? I think there's a good chance, honestly. I think there's a good chance that the tariffs are going to be not as bad as feared. So it could end up being like a sell the rumor, buy the news sort of an event, right? Okay. But after that first week, then I think maybe I can kind of make a conclusion about what this market is doing. At the moment, the treasuries seem really oversold to me, but by the way, I don't know if you're... I feel like I gave you a good... enough. I was saying 23 was where our cost basis was, right? It moved a little bit, but yeah, it worked. Of course, that might just be like might do that, and then you would say like the line doesn't matter, but sure seems to matter a lot when I'm looking at it. Yeah, okay. It hasn't been proven to you. You think it doesn't exist. Yeah, no, it just hasn't been proven, period. Right? When you say it's been proven to you, that's like, we have to look at what is the definition of something being proven. So something being proven would be that empirical evidence has been generated that conclusively show a particular behavior about markets or reality or whatever the thing is that you're talking about. So it hasn't been proven, but what has happened is you believe it. You believe it, and you believe it not because of empirical evidence. There you go. Empirical data is quantitative in nature, which aims to avoid biases and test null hypotheses to some statistical significance. Yes. And man meat, when the real key here thing about empiricism, though, is that empiricism means that it can be shown or demonstrated to other people through experience. So what I mean by that is, you might have this thing and say, this thing tends to happen, Like there are swans that are black. And you say, well, how do you know that there are swans that are black? I went there and I saw them. Okay, so what is that? That's you can't see. I saw them, but you didn't see them, right? So in order to prove that there are swans that are black, I would, I can go and find a black swan. I can go and collect a sample of it, right? And now everybody can look at that swan themselves and see it is indeed a black swan, right? Because there can be all sorts of things like you have a strategy, you think that strategy works. There's all sorts of reasons why you could be wrong. You might have been lucky. The actual edge might be coming from something that you don't understand. Like you think it's this thing and it was actually this thing. That's extremely common. It could just be a function that market, it's a bull market and everybody was winning in that bull market. Well, more often than not, it's just that you're naive, that you don't have enough data to actually make the claim about the market that you're making, right? If it's empirical, we have this data, I can go and I can look at it and I can say, okay, here's your strategy. We've back tested it across the market. I can change the data that I'm running it on. I can say, like, run it on this time period or this time period, run it on this instrument versus this instrument, right? And then I'll have all that information to be able to say, oh, actually, you didn't collect enough data. You haven't actually proven something because you don't, right? Like I can double check your work now at that point, right? That's why the empiricism is so important, because otherwise you are basically stuck with just trying to trust what somebody else told you. How do the 5% win? Well, there's a couple of strategies that we know of that are proven strategies. The win rate in futures is not necessarily 5%, but it's kind of a complicated thing. For like what we're trying to do, like scalping futures, the win rate is 5%. Okay. And why do the 5% that win, why do they win? I would bet that probably 3/4 of them were just lucky. Yeah, I think 3/4 of them were just lucky. I mean, if you extend it out to like a 5-year time period, probably only like 1% actually really are making money from it. And what is he doing? Well, I don't really know. We could go and I haven't found somebody that's actually like made money every year for 5 years in a row purely from scalping futures. I've not met that person. So you can ask what they're doing. You find them, you can ask what they're doing. But what we're talking about is, what does the market actually do, right? And one of the things that we know the market actually does is that it reacts to all orders. So if there's a particular strategy you're employing in there and it's popular enough, it kind of moves the market and kind of removes that inefficiency from the market. So whatever they're doing, the one thing that I do know is that it's probably going to be very different from what everybody else is doing, right? You have no empirical evidence that it was like, yes, we do. The way that this works, Tilt, is that you can come and say, okay, here's what a random data set looks like, and here's what our data set looks like. And is our data set sufficiently different from the random data set to show that it's extremely unlikely that our data set was produced just from randomness? Okay. And this is where you get into all of these measures of like the margin of error and things like that, right? Omar says, so wait, it's not possible to make an income from trading by scalping? In today's world, it is extremely rare. And if you do make money from it, because I've done okay past 2 years. I had like one blow up that kind of screwed it up at the beginning, that kind of screwed up 2024. But other than that, we did pretty good. It's not a ton though. I'm not making millions of dollars from it or anything like that. Don't do it if your goal here is to make money, you know, to leave your day job and yada yada. Probably shouldn't do that. You have this kind of market god complex where you know how every trader fails and has periods of success. I just know that the statistics are tilt. And I'm an asshole. So if somebody comes in and they think that they've made it, and I can immediately see that they're falling into one of these well-known fallacies that retail traders tend to make, then yeah, I love to burst their bubble. I love it. I love it. And what'll happen is they'll be like, no, it's not random. I'm smarter than everybody else, and I'm one of these profitable trader people. And I'm like, okay, come back when you blew it. And then they come back 6 months later, and they're like, yes, you were right. And I wish I could say at that point that probably don't wish that I could say, but you would think that I would say at that point that then I love that part, but I don't find that part enjoyable. Because then at that point it's sad. It's like, yeah, you had made hundreds of thousands of dollars, and if you had just realized that it was random and that you were lucky and stopped right then and there, you'd have this huge pile of money to sit on, but you kept going. Like, nobody comes back and tells. It's happened to me a couple of times, Susie. Actually more than a couple of times. There's also been a couple of times where there was like particularly aggressive a-hole or whatever that I remember, and then they came back and posted that they had lost or something because they said it was emotional issues. That's happened. Oh, it's been in our streams. I can remember at least one person. I don't remember names. Actually, I can remember at least 2 times. Well, I can remember a couple of people that, well, like Kevin is an example where, you know, he was having a bit of success with something, but we were like, okay, that's pretty good, but, you know, not long enough yet to really know for sure. And then, you know, it kind of didn't end up working, right? But that one was not an antagonistic. Yeah. So you're saying don't pursue trading with the idea to make it a full-time career independently. Yes. I would not recommend, especially not day trading futures. If you have a decent amount of money to begin with, there are some inefficiencies within stocks that are a little bit easier to take advantage of. But futures and like scalping, you're playing in an extremely efficient arena, so it's extremely difficult to have success with it. And, you know, there's this kind of other argument here, right? Because my argument is not, I don't know, again, Tilt is kind of straw manning things, right? Or scarecrowing things. Like he's making up an argument that he's claiming I'm making that isn't the argument that I'm making, because that argument is harder for him to beat up on than the actual argument that I'm making. My argument is not that retail traders can't make money from it. Okay. My argument is, how does the market actually behave? And my argument is that if all you have is a 1 or a 5 minute chart of an individual asset, that you're probably not going to find any alpha in that. That's my argument. That's the null hypothesis. And the hypothesis that everybody else in retail trading has is, I can see a particular pattern in a 1 and 5 minute chart that will bring me profitability. And my challenge is, prove that empirically. Nobody can do it. And some people kind of go, oh, yes, that's right. I do believe this thing that is not empirically proven. Why do I believe that particular thing? And then they say, well, maybe everything that I thought was, that people on Reddit told me is wrong. Maybe I should go and look at the empirical evidence and at least learn the things that we do now that are empirically proven, right? Some people do that, but some people, they just can't seem to let go of what they think they already know. And so they convince themselves that doesn't matter, that they can't prove it empirically. Futures is such a wild game. You can submit an order, be at the back of the queue, and watch the LPs pull and stack your price over and over again to change your position. And yeah. We have, I really think that if you come in and you start trading futures and you get really good at that, and then you come upon money and you go into 2 different games, like swing trading futures, or trading stocks, you really, really know yourself and you have an advantage there in that point, right? But do you trade? Not today. We took one yesterday. Well, actually, we did. We took a tiny little trade today. Actually, we did. Oh, well, you're saying empirical evidence is needed to make money? No, it is not. Empirical evidence is not an essential element to make money. In fact, I would say that the best way to make money is luck. So go and buy some spicy eel and eat the spicy eel every day, and then you'll be a good trader. That's what you need, right? Nobody's coming back with anything, so they probably don't know what I'm talking about. Don't worry about it. Forget it. I totally have gotten so much on this rant. I still want to do this one thing here. Save as. No, I don't want to put it in OneDrive. Stop that. Stop it. Stop it, Microsoft. They don't like OneDrive. And we got Goolsby speaking here. Better. Okay. Close these. Like here's the thing. Okay, going back to the other question you were talking about. You're going to have to go and explain that, yeah. Okay, see here, you spicy eel. You cook it up, it gives you a +1 buff to luck. You eat it, it lasts for 7 minutes. So you have to have a lot of it, but that'll increase your luck and make you a profitable trader. Some spicy eel. There you go. So we know that 95% of retail traders lose, right? So why would I think that I can go on the internet and I'm going to find good information about trading? right? Shouldn't, if 95% of retail traders lose and the information that I'm getting is coming from other retail traders, then shouldn't 95% of that information be bad information? Right? Like, so, okay, sure. Most things that I do that I find on the internet aren't going to work, but I can try them anyways, right? And I try enough of them, eventually I'm going to find something that works, right? Okay, well, again, remember that you need a lot of data to like really prove something. So you might have something that works for a year and then it stops working. That's super, super common. And if I want to be able to continue doing this for decades, right? How many times can I actually do that? I'm going to find a strategy. I'm going to get good at that strategy and then trade it for a year and find out that it doesn't, it's just not working for me. And now and I've just wasted a year. Okay. You're only going to live to be like 100. And I don't think that you're going to trade for all of that time. So like realistically, you maybe get like 30 shots at this, right? 30 shots and like 95% of them don't work. Like that's not going to work. You're never going to find anything. And I know traders that they've tried a bunch of different technical analysis systems and things like that, and they've been doing this for literally decades, and they're not finding something that they think works, right? So you need a filter. You need some way to say, this thing is worth pursuing and this thing isn't. And I'm trying to give you two really powerful tools to help you filter that out, because I'm not just going to give you a strategy. If I have a strategy that I think really, really works, I'm going to keep it to myself, because alpha decay is a real thing. Okay. And that is the first one that is going to tell you, is that if it's popular, it probably doesn't work, because the edge will have already been taken out of it, right? You have a strategy and it works, you're going to keep sizing up. You're going to, you get bigger and bigger until you've taken all the alpha out of it. Okay. So it's not going to be something common that everybody knows about. That's the first thing that tool that I would give you. The second tool that I can give you is that if it's based on just using a 1 or a 5 minute chart on a single asset, that it's probably not going to yield something. I would love to see some evidence that you can find a real proven, something structural to the market that you can display with just a 1 and a 5 minute chart. But there are things to volatility, but being able to predict what direction it's going to be going over the next 20 minutes with a 1 or a 5 minute chart, good luck. I've never seen it. Probably not. And honestly, I don't believe it exists. I don't believe it exists. I would love to see somebody empirically prove otherwise, but everything that I know about markets suggests that that's just not going to be sufficient enough information to actually find a real edge. Okay? So then the last filter and the most powerful one that you're going to have here is that there's actual empirical data backing it up. Because there are things out there that is empirical information that we can prove about markets. Okay? The square root law of meta order impact is a well-proven thing that markets does. It's kind of weird. We could just describe that a little bit more, but it doesn't necessarily tell you what direction it's going to go. So I don't know if that gives you an explicit edge, but it is something about markets that is valuable, right? But the key thing here is like I can prove it empirically. There's all these data sets I can point you to, and you can run and you can see that, yeah, well, a large meta order, the impact on the market tends to follow a square root law. We can prove it empirically. So my suggestion is, if you really want to find a workable strategy that to maximize your chances of finding one that works, you should look for things that have empirical backing. And just ignore the people that say, oh, I've got this thing, it works. Yeah, he'll prove your rule-based strategy failure with backtesting nearly 100% of the time, but he doesn't have a rule. Well, so I do have a strategy. It's not really super rules-based, is it? I honestly think that we could train an LLM to trade the way that I do. It's just beyond my skill at this time. Yes. It's not, I think that I could train an LLM and machine learning and kind of pick up all of those things. The thing that I can't automate is the data, right? Like I'm gathering data from everywhere, I'm reading all these articles on Zero Hedge, on CNBC, all of these different news websites, things on Twitter, all of that sort of stuff, and I'm finding individual facts and incorporating that into a model in my mind about what the overall economy is doing and what individual players in the market is doing, and combining all of those things together into decisions about what the flows that day are going to be. And I don't know how you scrape that information reliably and get it into a robot, If there was some, XML feed that I could put, So I do think that it can be automated, but and part of it is like, okay, well, I need a platform that's got enough data so that we can do that, right? So maybe someday I do actually automate it if we get all our data, because basically it'll be like, hey, we get enough order flow data to kind of like solve that side of the puzzle, right? And then I can go and look at the more of the LLM side. So we might be able to we might be able to automatize a strategy and show that it's a successful strategy or something like that. But that's where I come in, and it's like, I don't make any claims about my own performance. Even if I was doing well, there's kinds of some regulatory issues and everything that kind of makes like really going out and saying you should listen to me because I've made money from it is kind of like not very wise thing to do anyways. But that's why I really feel like that the focus should be on the market. What doesn't matter that I've made money or you've made money. What matters is, what does the market actually do? What can we actually prove about the market? Right? And what pisses me off is when people make claims about the market that they can't prove. That's probably true. If you put Seth in the 30-year with single contracts, he'd get smoked. But in the micro where the tick value is low, he can hold unrealized losses without pissing himself. That's true. That's 100%. Like the results that I've had over the past year, I do get a lot more MFE than MAE, and I think that is indicative of at least it's in the direction that we want. Because the issue is, okay, is it just from taking on risk? I don't think that it's just from taking on risk, but in order for it to work, you do have to take on a lot of risk. A lot more risk than I'm willing to take on full contracts, that's for sure. That's for sure. What I think is funny here is that you guys keep turning it into an argument about who is profitable. Who cares? You all care. Obviously, you all care. But I'm trying to tell you that that's not what you should be focused on. What you should be focused on is, what can you prove about the market? As a percentage of capital, what would you allow? Oh, I don't want to lose more than 5% in a day. Yeah, no, I know that you're not trying to argue with me, Uzi, but you're, that's what they're focused on, right? I'm just saying that you're not a mystery. You know what though? So okay, I think I told you this story already, but there was a prop firm recently that basically went under, and when they went under, some employees leaked all of the logs from their private Discord server of the administrators talking, and some of it was a little unsavory, basically like, oh, here's somebody that's that's passing a combine, but we don't like the strategy that they're using, and kind of they were kind of like scheming against traders, it seemed. But just the way that they talked about their audience, it really was like, haha, all of these suckers, look at all this money they were making from these fools that think that they're going to pass funded trader programs, and really they're just giving us money. So I wanted to get that information, and there was somebody that they put it on their Discord server. So I went and I visited that Discord server, and I intended to just go in there, get the data, and get out. But for some reason, even though I'm a super tiny YouTube channel that, I mean, listen, we've had a lot of success, and having, what, 16,000 subscribers now is like way more success than I ever dreamed of having. But it's not like I have this huge reach or whatever, right? But for some reason, I enter into somebody's Discord. There's always somebody that recognizes me and immediately sees that, you know, there's those channels that say like so-and-so joined the server. They immediately see that I joined the server and start talking to me. So they're going through all of this stuff, and, you know, they asked me about it, and I said, nah, I think that prop firms are essentially a fool's game, is what I think. And there's all these guys that are like, oh no, it's totally, like, you can totally consistently pass it. Which in and of itself is a bizarre claim to make, I think. It's like, if you're really that good, shouldn't you only ever have to pass it once? But whatever. So they were getting into this thing with me. And it kind of, I was able to get them to focus on, okay, like, I really don't think that you're going to do all that well if all you have is 1 or 5 minute chart. Like, past price is just not very effective at predicting future direction at all on an intraday basis, on a single asset. It just isn't. Maybe there's enough in there that maybe you can find something and make money from it, and go ahead and prove it. I would love to see it, but I'm going to say it's not very, because we've tried a billion different things and we haven't been able to collect empirical evidence that suggests that you can do it. Okay. And so they got into this thing that was like, okay, so how do you trade? And I explained it to them. And, like, it completely went over their heads. Like, they did not understand what I was saying at all. This concept that you can trade without looking at the price was just, like, made no sense to them at all. And they're like, what you... Yes, I'm talking about the Mighty Ox Discord. And somebody said, well, like, what you're saying makes me feel really stupid. And I'm like, well, I'm just telling you how the thing works. I have no control over how you feel about it. But they didn't like that, and they banned me. If I could go back 16 years in time and give myself one piece of advice, it would be ignore everyone who tells you how much money you're going to make trading. Would have sewed up the process. You probably wouldn't have kept trading, maybe. You can do it by hedging. Well, I've heard so I think I might know what you're talking about. So there's this thing that people have done where, like, you trade like a highly correlated asset and you take both sides of it, and then you take profit on the one side and you'll let the other side come back to break even at some point and take it off. and this is something that like it's not like a net profitable strategy in the long run, but like you can pass combines with it, and like they actually have rules against it, I guess. And that was in the Mighty Ox Discord. One of the things that we found was them talking about a person that was doing that. Yeah. Oh, well, okay. That's a different thing. Kevin says you can do like a 10-year YOLO, 10 YOLO long and 100. Yeah. Do go long on one instrument and short on the other instrument, but do it on different accounts, and then one of them will pass. Yeah. Totally. Coming down to earth and trading smaller and on a higher time horizon is also an alien concept to return. Yeah. Well, because they've built, you know, they're trying to trade, and they're trying to trade with a chart. And so everything that they've learned is about the chart. So when you kind of start talking about trading with things that have absolutely nothing to do with the chart, they don't have any context or to really even make sense of that. Totally. Do it between prop firms. That's there's an idea, Kevin. I gotcha. Still, I've seen there's all these people that are like, I can pass the combine 9 times out of 10, and I don't know how they're doing it, because they talk about like support and resistance and all of these sorts of things, right? And we try to find a way to kind of like duplicate those results, because I'm like, okay, that like I could see where like you could maybe make enough on that on a funded trader account that like it's not going to work in the long run, but it's going to work long enough to fool people. But I just can't like duplicate those results. But then that's what I come back to, like, if it really works, then shouldn't you only have to pass the combine once? Because if you have to do it multiple times, then what that's telling me is that you pass it, and what you're actually doing is you're just trading large enough that you'll pass and fail every month. Right? You'll pass it, you'll keep trading, you lose the account, start up again, and do that over and over and over and over and over again. Which is probably what they're doing if they've really had to take the evaluation that many times, you know? Korean guy, how are you? I heard PayPal did it. Oh, you know, I think I remember a headline recently, but I don't remember. What you talking about? Okay, guys, before we go today, I want to do this thing, and I keep putting it off here. So hold on a second. I swear I have some R code in here where I make a distribution histogram, and I would really like to do that. So hold on a second. I don't think that I have it. No, oh no. I'll have it on the old drive, probably. Maybe this one? Oh, that's something different. That's kind of cool, though. That's it right there. Okay. So we need read XML, SM, ggplot, data. Okay. And oh, I think I can just do that. I think I can say so. My data, read Excel, C colon slash work slash tilt .xml, or no, CSV. It's a CSV, right? CSV columns numeric. And the rest of this can just go away, I think. Like that. Okay. And then over here, the longs was like my data. Yeah. So I should be able to say my data dollar MFV, I think. Okay, wait. Let's run this bit. What? Well, let's read XML. No. Yeah, I forget. I might need to like install something. Install packages. I go to this one. Hold on. And yeah, we can post the code in the paid Discord for sure. You're right. It is related to the honey thing, yeah. Nowadays, if I do combines instead of straight to funded, I would do the YOLO news start with the account. There you go. Would have passed it. Yeah, today would have been enough. Yeah. Okay. Read Excel. Do we have it now? Yes. I don't know if I need these other ones, to be honest with you. Oh, because it is an Excel. Okay, wait. Does that work? Ha. My data. MAE, MFE. Ha. Hold on a second. Oh yeah, I think I can use ggplot to do it. Use something like this. No, maybe not. Okay. Plot density. Lines density. There you go. Hey, wait a second. Plot. I think that you just say something like color equals red or something like that. Does that work like that? There you go. Interesting. So there is a slight difference here on the densities, right? Interesting. But I don't know if that's... So that's not something that necessarily results in a profitable strategy per se. Oh, actually, I think that it could be picking up on the inverse sine law, right? So it's kind of saying like, okay, so the setup we got here is a bar, and then there's this slight next bar, and we take the trade right here. And what it's saying is that if it goes down, there's a slight chance that it will go down a little bit more than when it goes up. But it's actually like these ones where it's like the amount that it goes after that, you know? These are the two possibilities. This possibility is a little bit longer. What are we doing here? Yeah, so let's go and review. So what we do is we come in here and we are looking for a bar. Well, so first of all, we see how big that bar is. See the range of that bar. And then we come down here and we say if... Oh, this is the first part right here. Okay, so we see the range. And then if the range is more than a threshold, then we set this trigger variable, whether it's long or short. And then we return. And then on the next bar, it will come in and it will look at a trigger and it'll say, is this next bar like within a certain range, like it's smaller and has more volume than the first bar? And if it does, then it enters a position here, long or short. Okay. Then it sets a timer and it stays in that position for 5 bars. And then afterwards, we look at the MFE MAE. And it says to us that it takes more adverse excursion than it does favorable excursion. Now, that was trading against the trade. I kind of wonder. I wonder here. So like when you come in here in NinjaTrader, there's this analysis tab, right? Where I can look at like MAE and MFE. But I'm saying I want a density plot. So the way that I'm getting a density plot is I'm coming over to this trades bit, or right click, export, tilt to, oh, actually we won't call it that. Oh yeah, XLSX. Tilt to, save. Comes up here. I want the MAE, MFE columns. I'm just going to create a new blank workbook and paste those 2 columns in here. And save it as... Ignored all of Microsoft's stupid crap. Come here. We're going to change it to a CSV file. .csv, save. Okay. Same thing. Interesting. Oh no, it is opposites. Huh. Okay, so there is a slight statistical aberration in here. Although not necessarily one that you can take advantage of. Okay, so let's see if I can sort it out. And what was it, by the way? It's pretty thick there. That's for sure. Oh, that's interesting. I don't know exactly how to get... Okay, so let's do it like this. X lim equals 100. No, it doesn't like that. Oh, I see. So it's somewhere around 20. I don't know if you need this part. Well, that doesn't help you very much, does it? I don't know if this will work or not, but let's just try it, okay? Do I have it in here? No. So by the way, coming back to this is the one that is unprofitable. But it's maybe suggesting that it's not unprofitable because of the losers are bad. So we're gonna do something like else if state equals state dot configure set profit target set stop loss stop sign. Oh. Say it, set the calculation mode. I don't think I drank enough water this morning. I see. This makes sense. I'm new here. Well, if you have used our studio, I would love that you stick around. Not very many people have experience with that anymore. Takes me back to my PhD. Oh, wow. What do you have a PhD in? I'm going to set like a really wide stop. That doesn't quite work out. What if the stop is closer? Better. Oh, a lot that you have. Oh, that's interesting. Okay, so I am able to get it to show some interesting results, but what I'm getting kind of looks to me like something that you're just not going far enough back to show, right? Oh, very, very interesting. You know, it might not be working here because I'm using set numbers. Oh, actually, you know what I gotta do? Coming back here, I just shouldn't set the stop loss. That's what I should do. That might like really ruin it, but because the losers probably end up being so terrible, huh? Oh wow, does give you a really high win rate, that's for sure. But when you lose so. Give it a little bit more time. No. I mean, really, you want something that's just kind of really good straight line, right? But yeah, so the bars exit. Let me change it back over here again. The bars exit is basically, we're using time exit. So it takes a trade and then it stays in it for a certain number of bars. And that's the bars exit property controls how many bars it keeps it for. So like it's basically saying, okay, if you get this signal, is it more likely to be favorable after 20 minutes? And what you basically get is it's random. There does seem to be this little thing that like So here you have this point, and here where we take the trade, and here is plus 20, and here is minus 20. And it seems to get to this plus 20 a lot more than it gets to this minus 20. So I think that is just kind of seeing, it may be an aberration caused by the propensity for the S&P 500 to move up, is what I think the difference in that density plot is showing us. But the difference there is not super huge either. So it's not, it's not outside of the margin of error, I don't think. It's not something that I think you're going to find a profitable strategy out of. But it, you know, it was kind of worth. And that's kind of why I went back and changed the set stops and targets and everything, and tested a little bit, and then looked at the results on it to verify that then, yeah, okay. When I do that, I can see it's, you know, there's periods where it works really well and periods where it doesn't work very well. So it may just be random. Or it's likely, rather, it's pretty likely that that's just random. But I wanted to do that because I wanted to show, okay, how do I do like a statistical test of the market, right? Well, you can run the strategy analyzer, but what you can also do is, you know, I don't necessarily care like what is the net result of the strategy and all of these sorts of things. I just want to see statistics from that point. What is the most that it goes in my favor and the most that it goes against me? And then you can graph them on a density plot. Super cool. Super cool. You can also, let's come back here. Is it this one? Yeah, this one. Profits. New. Save as, browse. Was this window that Windows pops up that asks me if I want to use OneDrive? No, I don't. CSV file. Built free.csv. Come back here to R. My data 3. Tilt. 3. Plot density. My data 3. Profits. Don't need any of this extra. Did I not just save it as tilt 3? Come on. Apparently, I did not save that. Sorry, where did I put the files? Oh, I see what happened. I see what happened. Just put it in the wrong folder. There you go. So what we're seeing on this is I would say not what I kind of theorized. So I theorized that there would maybe be more kurtosis to this than you would normally expect. But when you look at the edges of this, like between 100 and negative 100, when we're looking for a bar that's like 20, you know? So the idea that creates now maybe it's just because it's not a strong enough effect. So then that's the next thing that we can do is we can say, let's make our threshold much larger. How many do you get this way? Not very many, unfortunately. Hmm. $50 and $25 maybe. Interesting. Probably a more elegant way to say do that. In fact, I'm certain I've done that before, but optimization. From 0 to 1. And then these thresholds will go from 10 to 100. We'll let it do it by profit factor, but we only want to go back to 2024, otherwise it will take forever. Oh, wait, that can't be right. By 10. There we go. Okay, so let's see here. BS asks, so the next question is what happens when it 1/loss ATR instead of candle size, maybe? Yeah. The ATR would be like the next step, sure. That would allow us to go further back and do it on different instruments and stuff like that, yeah. There's a couple that only took one trade, that's funny. This one, I'm gonna like, okay, don't, oh, I don't know if that matters. Run that again so we can sort it a little bit better. I should have anticipated that. So what it's doing is it's basically saying, oh, the best strategy is this one where like it only happened one time. Yeah. There you go. Oh, hey, I actually found one that actually took a reasonable number of trades too. So what did it like? A threshold of 30 and a doji threshold of 20. There's actually ones that it takes a lot of trades. Oh, where the doji threshold is larger than the threshold. That's hilarious. Okay, but what I wanted to do actually was come and do an optimization graph, right? And then we can say, well, so first of all, there's direction. Not much difference on the direction. Just kind of what I thought, but might as well check that. And then the doji threshold. Oh, wait, what? It busts the optimization graph. What's with that? I feel like maybe there's something to that, but I think that it's probably random. Probably random. So now you've tried all of the different settings on candle size. Now we could change it and we could say do it based on a percentage of the average true range on a daily basis, for instance. Right? And that might bring some in and some out, but probably not. If I'm not seeing a whole lot of interesting statistical aberrations through here, it's probably not worth taking it that far, you know? I do find interesting. There is this one. There are some ones at the top that look pretty good. That looks pretty good. But it's also kind of like, it didn't actually take that many trades. Yeah. Well, that's interesting. Total efficiency is up pretty good, though. But that's where you basically at that point you say curve fitted. But I don't know, 60 trades over a year. It's kind of like it's not enough. 0.03 trades per day. So that's going to mean I'm actually surprised that the probability is up as high as 14%. Oh, actually, you know, because what we need to do is to go back to 2019, right? That'll help a little bit. Hey, it survived that at least. Just doesn't trade that much though, fortunately. So, oh, so maybe I need to do. Oh, so I had this sorted. How many did I tell it to keep? Oh, only the top 20. Okay. Well, of the top 20, what are the ones that like took the most trades? Right? So this set in here. I guess I'll do this one. Because this will probably give you a better picture of like the curve fitting. Hey, that's interesting, actually. It worked pretty well until 2022. That's kind of more the sort of thing that I would find that I'd be interested in looking for. Is like, if we go back to a low interest rate environment, maybe you could trade this. Although what you make on it, yeah, because if I include commissions, right, let's go back here to this chart. If I include commissions, yeah. Then especially if I add slippage, I bet it's just consistently down if I add slippage. BS says if he's actually using this successfully. Well, he's probably hasn't been trading for 5 years, so that's the first thing, right? If he had been using this for 5 years, then the question would be where is the edge coming from? Well, I wouldn't just assume that it comes from his setup, for sure. But this is kind of a weird thing that I think a lot of retail traders miss because they don't have all of the context. Is you'll get these professionals that'll say, like what you do, your entries and exits aren't that important as like how you manage the position and all of that. Well, the reason that they're saying that is because in a swing strat, a momentum strategy rather, in a momentum strategy, you're managing how big the size is, how much size you trade on each individual position, and you adjust the individual positions based on all of these different factors. And there's more edge and things that you can get from the strategy from that, rather than messing around with the entries and exits. And so that's why they're saying that. When we're doing scalping, where it's just like outright trades, where you go long or short in one individual thing at a time, that sort of stuff doesn't really make sense, because all you can control is when you get in and when you get out and what direction you pick. So how do you manage it, right? The things that you could do to manage it are mostly going to be things that make you take more trades, things that make you exit sooner, right? Or longer, or whatever the deal is. So wonder if you can do something where it's like, I want to time exit, but something can happen that will extend the time I give it. That would be cool. I don't know if we'd do anything, but it was an idea. It's an idea it's worth maybe trying. But I think I proved my point, right? So what should you take away from this stream? Learn to love eel, right? I've never had it before, but it can't be that bad, right? I don't know how I'm gonna get that in Utah though. So yeah, but maybe I'll have more information for you about spicy eel on Monday. I actually thought there was some interesting thing. Like the reason why I like zeroed in, because people will share me strategies all the time. I'm like, that probably doesn't work. But there was some things about that one that were actually curious to me, right? So find a Japanese restaurant. Okay, yeah, try that. So it was interesting to me, like, what's the best way to program this and make it work? So some interesting results there. That last one, it was interesting that it worked pretty well up until 2022. So when I've been looking for something like that, actually. Been looking for something like that. That's really interesting to me, actually. So but it was doing it where, like, okay, so you have a bar that's a relatively large bar, and then the next bar is even bigger, and then you trade on that. It is kind of like a way of doing time series momentum. And so time series momentum on a short-term chart, it's always been random, but that was one where maybe it wasn't random, and it was actually based on the interest rate regime that we were in. And I've been looking for something like that. So that was it. But it was like an aberration of the strategy that, shouldn't happen, essentially. So yeah, okay, guys, I gotta get going. I will see you on Monday. Stay X.